Und wie Sie schon erwähnt haben, kommen wir jetzt zum eigentlichen Thema des Tages oder jedenfalls zum Kern des heutigen Treffens. What is Islamic Finance? Und wie unterscheidet sich islamische Finanzierung von der im Rest der Welt? Und welche Produkte werden in diesem Bereich angeboten? Dazu hat die Kammer einen wirklichen Experten eingeladen, Herrn Abdelhak El Kafsi. Herr El Kafsi gilt als einer der Gründerväter des Islamic Banking in der arabischen Welt. Er ist gebürtiger Tunesier und ist 1992 in die Arab Banking Corporation, ABC, eingetreten. Dort hat er auch den Bereich Islamic Banking, der damals, wie schon erwähnt wurde, ziemlich in den Kinderschuhen gesteckt ist, stark ausgebaut. 6 Jahre später hat er sein eigenes Beratungsunternehmen gegründet, an dem unter anderem auch ein Staatsfonds von Abu Dhabi beteiligt ist. I'm delighted to ask Mr. El Kafsi to address the audience and introduce them to some of the main points of Islamic banking. Please, Mr. Kafsi.
Ladies and gentlemen, good morning to you. A warm morning from the Gulf. What I have tried to do, or what I will try to do today, is to demystify the notion of Islamic finance. Islamic finance, in the minds of a lot of people, is something, a lot of cash, mixed with some exotic structure, sometimes also with some geopolitical issues such as terrorism. And to illustrate this, in fact, I'm going to tell you about a small anecdote which I have lived personally. I was visiting Boston and for the purpose of discussing the creation of a private equity fund. And they needed somebody to check with the various debt products that they can have recourse to when it comes to structuring a private equity deal on an Islamic basis. And the second day, when people were a little bit more relaxed about talking to me, one of them, and this is a banker, a senior banker, came to me and he says, I have to confess, before I learned what Islamic finance is about, I have always had this impression that it is a mix of cash, of Islamic extremism or terrorism. And in fact, I always imagined myself in a board meeting with my new board members representing an Islamic investor with long beards and beads in their hands. And then if we argue about a point as management with this board in order to ensure that we deal properly or we manage the company properly, if one of them gets angry, he will take out his Kalashnikov and kills us all. So this is not something which is, this is rather something which is significant as to the certain level of confusion in the minds of people as to what Islamic finance is about. And again, the idea today is to try to basically demystify to the extent I can the idea of Islamic finance. First of all, a very short word about Islamic Finance Consultant. It's a company which was established, of course, in Bahrain in 1999. We are licensed by the Central Bank of Bahrain as being an Islamic Finance Consultant firm, and it was set up as a joint venture with Abu Dhabi Investment Company. We act as advisors, and we act as financial arrangers, brokers, for those who need us, in other words, corporates, banks, and governments. These are some of the mandates that we have worked on, and the choice was based on the types of deals we have managed, from private equity placement to sukuk structuring, to some innovative structures relating to mezzanine financing, all the way to establishing Islamic banks. Now, if Islamic finance is an industry which, if I may say, had started in the 70s, but had started growing really in the 90s. And it has experienced a very rapid growth, both in terms of size as well as in terms of geographic spread. We expect that by 2015, and here I'm talking about MENA only, Middle East and North Africa, we expect that the volume of Islamic finance reaches close to $1 trillion, and that is only MENA. We have a number of newcomers in the industry. Newcomers means new countries where Islamic finance starts to be developed now, or is likely to start being developed, and where growth is expected to be quite fast. And mainly these countries include North Africa and Egypt. If we look at Islamic finance worldwide, it is expected that the figure of 1.1 trillion be reached and exceeded this year, by the end of 2012. I mean, these figures, in terms of the total, say, size of world finance, are almost negligible. It's very, very small. However, what is significant is not the figure in itself, but it is the growth. And the growth has been very fast. What has been happening recently in the markets, or over the past 5 years, if I may say, in the market, has created a lot of curiosity and has forced a lot of people to think about Islamic finance as being a viable alternative, as being another source of funding which should not be neglected, as being one safe way of basically going back to the roots of banking and doing some common sense banking. And all of this is contributing again to the growth, both in terms of size as well as in terms of geographic spread. And the countries that are mentioned there are, to a large extent, newcomers to Islamic finance, and they're expected to develop this area of finance fairly quickly. Islamic finance is a set of ethics, or a set of ethical rules to manage the relationship between, say, the user of funds and the provider of funds. That's what it is. And these set of rules, because they emanate from religious law, are ethical. So when we talk about Sharia, Sharia is basically a set of laws derived from Quran Quran, which is the holy book for Muslims, as well as the behavior of the Prophet. Peace be upon him. Wealth or money in Islamic finance is nothing but is perceived as being an asset which is given in trust by God to human beings, and for that reason it has to be dealt with in an ethical manner. And the first basically set of rules relates to the don'ts, and therefore the prohibition of unfair or oppressive practices such as riba being usury, which means an excessive level of interest, gambling in the widest meaning of the term, in terms of taking undue risk in the use of money, cheating, of course, and lack of clarity in contractual relationships between the provider and the user of funds. The promotion of honesty, transparency, justice, and fairness in commercial dealings is the basic of Islamic finance. And then establishment of measures to protect the rights of parties who are involved. Again, I mean, if we look at, generally speaking, the concept of Islamic finance in the minds of people who have not been exposed to it, is generally that of lack of knowledge about the principle of Islamic finance and a simplistic, say, approach to interest is prohibited or this is only for Muslims. No, I mean, Islamic finance is again an ethical approach, and you can have a transaction which is called Islamic and where the manager can be, say, a Christian, the borrower can be a Buddhist, and the lender can be of Jewish faith. The contractual relationship between these parties is what qualifies the transaction as being Sharia compliant. It's not the faith of any one of them. So hence we can, while we call it Islamic finance, because it is subjected to the, say, Sharia law, we can pretty much call it also ethical finance. So, and hence we see more and more a high level of interest by ethical finance funds in co-investing with Islamic funds, because the basic principles of both are the same. Again, the most important aspect in Islamic finance is that money is not a commodity which can be purchased, sold, or leased for a financial consideration. Money is a means to create wealth when it is put to use. And profit can only be recognized if the productive use, if money is put to productive use and an economic added value has been created. So profit should be equal to the economic added value created, and therefore it is justified by the value addition it creates rather than by just sheer time value money. So money breeds money. This is in contrast with conventional banking, where money breeds money regardless of whether it is put to a productive use or not. Time value money is the most important component. This is not what, this is the main difference between conventional and Islamic finance. So, if this is the concept, how can we, in Islamic finance, how can we, in the Islamic financial industry, basically do our business in a profitable manner? That means, how can we give returns to whether depositors or investors? Well, we have to ensure, therefore, that the money that we have is invested in real economic transaction, and we have to ensure that, we have to verify that, and we have to measure that the economic value addition, and therefore acknowledge the profit that we will be distributing to either the depositors or the investors. Very, very simply put, the Islamic bank or the Islamic investor provides cash in what I will call a partnership with a customer who has technical expertise but lacks money. So we have here the combination of financial resources and economic management expertise, which together create an economic activity, which in turn creates a value addition. And that value addition, which is created as a result of the combination of both, is then translated into money and shared between the provider of funds, which is the bank in this case, and the customer or the entrepreneur. That's a very simple and very real way of how Islamic banks work. The relationship between a bank and its customer is that of partnership. Now, a bank in Islamic finance never acts as lender, because lending as such does not exist. And if it exists, it has to be in a benevolent way and without any remuneration. And there is what we call qard al-hasan, which occasionally a bank has to do for, say, social responsible issues. But otherwise, for the business it is in, which is creation of value for its shareholders, it does not lend, but in fact acts as a partner in an economic activity with its customer, and becomes a buyer, a seller, a lessor, or a contractor. Literally, these are the functions that the bank assumes so that it enters into an economic activity which will ultimately justify the profits it will earn and the profits it will distribute to its customers. Now, how does it undertake these activities? It undertakes these activities directly if it has in-house expertise. It addresses these activities through its own trading or other types of companies. It addresses these activities through special purpose vehicles, like in conventional finance when you have SPVs and SPCs. And finally, and the most commonly used structure, it acts through agency agreements that it signs with its customers. So it appoints its customer as its agents to purchase a commodity or to sell a commodity or to build in the contracting business. And in this kind of relationship, you will see that the bank has become a direct economic operator, and it undertakes an economic activity, again, which in turn will result hopefully in a profit if the deal is well done and therefore result in what is an important aspect in Islamic finance for recognition of profit and economic value addition. Now, this is another aspect where there are a lot of, there is a lot of lack of clarity in terms of the perception of a number of people who are not familiar with Islamic finance, which is the role of the Sharia Committee. The Sharia Committee, as far as I'm concerned, is an audit committee. It's an audit committee which is there to ensure that the principles and the laws of Sharia, according to which the bank promises its shareholder and promises its customers will abide to, are followed. So the Sharia committee is there to assist the bank in ensuring that when structuring the deal or when documenting the deal, they have the proper structuring and the proper documentation, but also audits the books, the transactions, the legal documentation of the bank to ensure that they comply with Sharia. So a Sharia board or a Sharia, what I would like to call a Sharia audit committee, is a function which is very much similar to an internal audit function in a conventional bank, but specialized in the area of Sharia, which differentiates, in fact, the bank from its conventional peers. That's what the Sharia board is for. Again, I mean, here I will pass over this slide. It's again a number of prohibitions in terms of allowed activities and activities which are not allowed. Now we come to the various modes of financing that an Islamic bank uses in its day-to-day business. Again, as a trader, a bank can help or can finance its client by buying a commodity and selling it to its customer on a deferred payment basis, which means that it allows them the working capital finance required to, or say, with holding a stock or an inventory on their books. Future delivery financing, which is SELEM, that helps with the pre-export finance. It helps traders with their pre-financing, the pre-financing of commodities they need to acquire. Working capital finance for construction is called istisna, that provides financing to companies to finance the manufacturing cycle of their products. Lease finance, ijara, is very much similar to conventional lease, except that in the agreements we will find small differences that are meant to ensure that there is a greater level of equity, of justice in the relationship between the lessor and the lessee. Fund management is called mudaraba. Musharaka is basically an activity which is joint venture activity. Islamic bonds are sukuk. So these are some of the, or most of the products that Islamic banks used. And generally speaking, when we look at the way a bank structures a deal, it does not necessarily always use one single structure. It can use a combination of 2 or 3 of these products to meet the specific needs of a customer in one particular transaction. So it does not necessarily have to be murabaha only, or istisna only, or salam only. No. often you'll find that it's a combination of 2 or 3 products which is used to provide a customer with a whole service for a particular transaction. Evolution of Islamic finance. I mean, Islamic finance is a very young industry. If we look at the history of Islamic finance up to the 70s, there was literally nothing. There was one small bank that was set up in Egypt. It's called Nasser Bank in the mid-60s, which was more of a cooperative bank operating on the basis of Islamic Sharia. But then it was not until the 70s that the nucleus of banks have been set up, and those were set up by Muslim entrepreneurs in Saudi Arabia and in Dubai. Faisal Islamic Bank being one of them, Dubai Islamic Bank being the other, and finally it's Al-Baraka Islamic Bank. And these banks, when they started doing business, mainly using one product, which is murabaha, and it was mainly done for trading purposes. It was not until the 1980s that the industry has developed to include another number of products and to become, part of the mainstream banking, at least in Saudi Arabia, with the coming on board of Al-Rajhi Bank. In the 90s, that's when Islamic banking has really experienced a boom, if I may say. That's when it really started developing on a large scale. Then we have the introductions of new products that are on the investment banking side. And it is not until in the year 2000 onwards that was the time when Islamic banking has really expanded and has developed to the level that we all know now. So, in summary, if we look at Islamic finance, it's an industry which I dare say is about 40 years old. It is much less if we look at the recent years during which the growth has really been important. So it's a very young industry, still at its infancy, and it is, but it is developing very fast, both in terms of size as well as in terms of geographic spread. And more, we see that, especially in non-Muslim countries, we see Islamic banking as being say, a product, like any other product, which would be used by borrowers to diversify their source of funding or for structured finance purposes. And this is exactly how, in my opinion, Islamic finance will develop. It's by becoming a mainstream product, looked at as being another way of approaching finance, another source of financing, or another financial engineering, say, a product that can help companies in their day-to-day business. Now, very shortly, we're going to go over some of the main Islamic finance products. The most widely used product in Islamic finance is murabaha. What is a definition of a murabaha? A murabaha is an unconditional contract of sale between a buyer and a seller, where the goods, cost price, markup, and payment date are all clearly defined and agreed. Generally speaking, a murabaha is about a sale with spot delivery and future payment. And this is the way that, say, a trader can be financed for a particular commodity, or not necessarily a trader, any company which needs goods of whatever kind can buy them on a murabaha basis if they need a certain financing period. Goods have to be, of course, acceptable from a Sharia point of view. You cannot go and buy wine on a murabaha basis, because there is a contradiction there. Wine being an unacceptable product cannot be financed on an Islamic basis. One very important requirement to avoid speculation and to avoid default is that the goods that need to be sold or that are subject to murabaha contract have to exist and have to be in the possession of the seller. Also, I mean, the entire specifications have to be very well spelled out, clear, and known to the buyer. The contract or the transaction goes as follows. There is an agreement on the payment terms and on the specification of the goods between the buyer and the seller. Second stage is delivery of the goods. And third stage is the payment of the goods. The seller in this particular case being the bank and the buyer being the customer. Future delivery, which is salam. As you have seen, under murabaha, goods are delivered and payment is deferred with a higher price. In salam, payment is in full, in advance, and delivery of goods is deferred. So it's exactly the opposite of a murabaha. And that is how a trader can obtain finance for goods he needs to collect from the market, or he needs to buy from farmers in order to basically sell in the market. I mean, this is a typical, this is a product which is typically required by large trading companies like Sukden and the others. Goods are of a commodity nature. And it is very important that in advance, prior to the payment, the specifications are very well known and detailed. And quantity and date of delivery also are defined for the contract to be valid and enforceable. In such a structure, typically, we have the parties agreeing to the payment terms and to the specifications of the commodity to be acquired at a future date. Order is signed and prepayment is made in full. And then, after the agreed period of time, which is the length of the delivery that has been agreed between the two parties, goods are delivered. Working capital financing mainly for the manufacturing sector, and it is called istisna. Istisna is a variant of salam, but used for financing of manufacture or construction. That means for a manufacturer of any industrial product, or for a developer who needs cash to develop a property, the product that is used is istisna. The payment can be in advance, or can be on a progress basis, or can be deferred. So this is left to the parties to agree upon. Of course, there are techniques to ensure, to protect basically the financier in terms of the delivery date and in terms of the quality of the goods to be delivered at a future date, and issues such as penalties and remedies are agreed in advance, as well as rewards for earlier delivery, for example. Again, a very important factor which needs to be there, otherwise the contract would be null and void, is ensuring that all specifications are very well known and defined in advance, that issues of delivery, payment conditions, pricings are very clearly spelled out. And if these elements do not exist or are omitted in the contract is considered as not Sharia compliant and therefore null and void from the perspective of Sharia law. The structure typically is, again, like it is the case with Salam financing, an agreement on the payment terms and on the specification of the goods, an order plus payments as called for in the agreement between the two parties, and then at the agreed date in the future, the delivery of goods by the manufacturer to the purchaser, and the purchaser in this particular case is the bank, with its clients being the manufacturer. Now, when we talked about the Murabaha, we talked about Salam, we talked about Istisna, we talked about the structures as they are and as they are practiced. But when it comes to the day-to-day practice by banks, of course, we will, in the second session, we will look at the practical aspect in terms of how these contracts or how these deals are actually undertaken. Another major Islamic product, or a product that is using in Islamic finance, I would say, not Islamic products, because Ijara or lease finance is a mainstream financial product used by conventional banks as well, is lease finance. I would allow myself to basically go to to this slide directly to basically highlight some of the aspects that are specific to Islamic finance that may not necessarily exist in conventional leasing, which is the issue of ownership and the responsibility that ownership entails on the lessor in particular. So all responsibility of ownership as regards the lessor remains with the lessor and cannot be passed on to the lessee. And this is an aspect which in most, specifically finance lease agreements in conventional finance, are not respected or are moved away from. And then the ownership responsibility, although the ownership is with the lessor, the responsibility of the ownership is transferred to the lessee. In Islamic finance, this is not the case. Also in the area of insurance and maintenance, the insurance remains the responsibility of the lessor, and the maintenance, there are two types of maintenance. One which is considered a routine maintenance that goes to the lessee, but the fundamental, if I may say, insurance remains with the lessor. Finally, the other major aspect is that what the lessee pays for is the use of the asset. So if for whatever reason the asset can no longer be used, then for whatever reason, which is not the responsibility of the lessee, then the payment of the rental stops until the asset returns or becomes usable again, because the contract between the both parties is the benefit of the usufruct. So unless the use of the asset is there, there is no point in paying for rental. And this is, again, part of the ethical aspect of Islamic finance, of the issue of equity, of the issue of fairness. Okay. Thank you very much. This is the end of the presentation. I hope I didn't bore you too much. Thank you very much.
Just stay here for one more second. I don't want to pretend that I understood everything here, but at least I tried to follow. But there was one expression which really struck me as something that I could not explain to myself, and probably not to others either. And that was Islamic mezzanine financing, because mezzanine in the German language is the floor between the ground floor and the first floor. That's the mezzanine, and I cannot.
Same thing.
And, I thought.
In English too.
Oh, it's in English too. But what does it have to do in financing?
Okay.
Go a little closer.
One very important principle in Islamic finance when it comes to shareholders is that all shareholders have to be treated on a pari passu basis. That means there is no difference between a shareholder from the other one. And for that purpose, you do not have the concept of tier 1, tier 2 capital, or of, again, mezzanine debt with mezzanine capital. These are things that are not, say, accepted under Islamic finance because of the issue of equity or fairness among all shareholders. When we talked about mezzanine debt, we talked about structuring, say, a layer of equity which, from the perspective of the Islamic investor, is not an equity, but from the perspective of the bank, is an additional amount of what the bank can consider as capital, because that amount will have to be lost first before the bank starts worrying about its debt. But it wasn't structured as equity. It was structured as a debt in a manner that satisfies the requirement of the bank as equity. So it is financial engineering.
Okay, that certainly it is. Thank you very much.
You're welcome.